Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. On the program tonight, we've got Adam Dawes of Shaw and Partners, and I wanted to talk to him about a story in the AFR which looked at the big sell-off of stocks on Friday. Now, three areas really copped it. They were tech, real estate, and also consumer discretionary. Now, I took the view that these are three areas that cop it when there's fears around rising interest rates, but eventually when rising interest rates are over, these are three areas that are likely to be beneficiaries of the end of rising interest rates. So I've asked him to look at a great quality company in those three areas: tech, consumer discretionary, and real estate. I then talked to him, I got Paul Rickard to talk to him about what he thinks about banks at the moment. I was supposed to do the interview, but I got caught up in a plane problem, so Paul took on the interview. And then we've got Michael Knox, who's a chief economist at Morgans in Brisbane, and he comes with the point of view that oil prices are going to start surging in the fourth quarter of this year, rolling into 2024. I wanted to ask him why, and then I wanted to ask him what was going to happen to the Aussie dollar. He's been a very good tipster when it comes to the direction of the Aussie dollar. He told me 6 months ago he expected it to rise, and I suspect he's going to say the same thing right now. He then looked at inflation and interest rates. Unfortunately, he sees two more interest rate rises. I hope he's wrong on that subject, but we will have to just see what he's currently thinking on this very, very testy subject. So that's the show. Let's kick off now with Paul Rickard talking to Adam Dawes.
Our next guest is Adam Dawes from Shaw and Partners. Adam thinks that banks might be a little bit more defensive than some people are making out. Adam, welcome to the program.
Yes, it's great to be here. Thanks so much.
We know the banks have been doing it pretty tough in terms of on the share market the last couple of months, although a little better the last few weeks. But you're thinking there might be a bit of value in these and that they might be a bit more defensive than many of the commentators are giving them credit for.
Yeah, look, the banks are always a favourite topic for us to beat them up on, and we, if it's not Telstra, it's the banks, so we can pretty much beat up on one of those two big companies. But yeah, looking at the banks and looking how economic conditions, and then basically running the scenarios through different drawdowns that we've had, or modern drawdowns that we've had in at least since year 2000. And we've done. It was a Citigroup research note that came out today that basically looked at these conditions from COVID, 2020, global financial crisis in 2008 and 09, and then further another market fall in 2002 and 2003. So basically they've said that the banks didn't perform well through COVID as well as through the global financial crisis, but because employment wasn't so full. Now, this time around, we're seeing those conditions that employment is looking quite full, and wages obviously still to increase. And they liken that scenario, or the ending scenario, to 2002, 2003, where the banks actually held up really quite well in amongst that time. And so, drawing those comparisons, they've sort of looked at it and sort of thought, well, potentially the banks might be a little bit more defensive than what everybody's thinking. And they also did some work on the amount of holdings or retail holdings that people have. And it's actually looking like the retail investor as well as the institutional investor is underweight the banks at the moment. So it is going to be quite interesting if we do go fall further into potentially having a recession. How are the banks actually going to hold up? And the lightning is that, or the potential is that they will hold up a little bit better than the last couple of downturns that we've seen in our market.
And that's quite different to sort of the current sort of scenario. Everyone's been saying your bank earnings have peaked. It's going to be really hard to grow assets. In other words, get any volume growth. Net interest margins are probably coming down. And hey, presto, bad debts are still at very low levels. And, they will sometime revert back to more of a norm, particularly if we go into a tougher economic time. So therefore, get out of bank shares. That scenario you're saying may not actually go that way. In other words, it could be quite the reverse. Banks are actually going to be reasonably defensive, hold up well, and continue to pay reasonably good dividends.
We have, yeah, absolutely right. We sort of see that, you know, NIMs or net interest margins with Commonwealth Bank definitely peaked last year. And November last year, that was the story. And you did see a lot of selling coming through on the banks on the back of that. It's not going to be as good as it was last year and those kinds of things. But remember, the banks are pretty safe now. They're just deposit takers and mortgage holders. They really aren't going too much outside of that. They're basically not allowed to do investments or any kind of high risk stuff anymore. The government has basically beaten them down to really just being able to hold deposits and mortgages. So that does leave our banks potentially in a better position. I totally agree with you as far as the mortgage side of things. That is going to be a tough space for them to navigate or work through. But yeah, it might surprise us to the upside if we still see some more downward pressure on this economy. Potentially the banks might not be a bad place to hide. Now, I know it's impossible to try and get clients to sell their banking shares. You know, it's impossible. But the research did show that retail clients are underweight the financials at the moment. And certainly my number one pick in the finance space is Macquarie. I think even if there is a downturn, it will come back, but or go lower, but it will then come back because these guys are very, very good at what they do, making money, rain, hail, or shine. So that'd be my number one pick, and potentially where you could hide a little bit if things do get a little bit worse.
Well, I'm certainly with you in Macquarie, and we'll note your comments about they might be good defensive assets. So don't sell all your banks. Okay, let's move on to some stocks that you do like. These are going to be more growth orientated, and we've got one from each sector. Let's start with the technology sector. We've nominated a company called Phineas Corporation, which I think is an insurance software. It's a global company, but talk about Phineas for a moment.
Yeah, so the questions were to me today is like, what are three stocks that you're going to hold for the next year? What next financial year? What are those ones? One is tech, and we're going to get consumer discretionary, and then we're going to go into the property sector. So look, Phineas is one of the ones that I really, really like. It is probably one of the most boring tech stocks on the market. And I think sometimes that's okay. That's okay to be boring. That's okay to potentially have something that isn't going to shoot the lights out. Now, we'd automatically gravitate to something like a Xero or a WiseTech in that tech space. But look, I think Phineas is one of those ones that does computer software for life, accident, and health insurance industries. And one of the announcements that came out the other day, which gave me a lot more confidence, they announced a new contract with Guardian Life. Now, Guardian Life does employee benefits, retirement, and income products, and it's the fourth largest mutual life insurance company in the US. Now, that's a really big company. It gives a lot of kudos to Phineas to get that moving. And also, we've got a buy recommendation here at Shaw's at $3.30 price target. But basically, looking at Phineas is trading on full year 2024 EV to revenue multiples around about 3 times, in contrast to a lot of its competitors, which is around about 7 times revenue as well. So I think there's a little bit of upside there. You look at the chart, it looks like it's probably got a little bit further to move, but nothing wrong with boring in the portfolio.
Yeah, if you don't know much about Phineas, I think it's ASX listed and headquartered, but most of its staff, I think, is in Dublin from memory.
Absolutely correct. Yeah, absolutely.
The chart looks all right, I must admit. So I had a look at that and one to put down. Okay, let's move on to consumer discretionary.
Yeah, well, this one's a bit of a hard one at the moment. And, you know, when we were just talking about potentially there's been some bad signs or some dark clouds on the horizon. I think you've got to be a little bit careful with this one, but certainly Lovisa is the one that I'm really liking at the moment. Look, like-for-like sales are going to be a little bit lower for the second half of this 2023. We know that it's all about like-for-like sales, foot traffic, as well as store rollout. And then we expect around
Lovisa is sort of in the custom-made, low-end jewelry market. Is that right, Kate?
Yeah, definitely. Yeah, Lovisa.
Probably you and I don't know too much about that, but I guess some of our relatives probably do.
I don't know what you do on the weekend, but that's fine. It's okay. It's all right. But no, you're right. It's that sort of low-end jewelry that they basically, you can wear it for 1 day, 2 days, and then you can throw it away. And it's cheap. You know, you sort of You don't go into Michael Hill Jeweler, or you don't go into Tiffany's or anything for these things. They are the lower end of that. But that consumer fashion, and wear it now, throw it away, get some more, is definitely a trend in there. But they are looking to roll out around 807 stores around by the end of 2023, the full year. That's down from about 830. So they're going to slow down that. And for them to reach that, they're going to have to open up about 11 stores each month up until the end of the year. So it's going to be a big ask for them to get that there. Like-for-like sales is down, as I said, but also that store rollout, they are looking to move into Vietnam and Taiwan. And that's slowed down a little bit at the moment, but they've also got 7 stores in Hong Kong as well. So they are sort of trying to tackle that Asian market and start to move higher from there. I think that Levisa's probably got a little bit more further to go on the downside. I'd like to pick this up at around 1750, somewhere around in there. It's currently sort of 19s, 18s at the moment. So I think a little bit further, put some orders in a little bit lower. I think you won't do too bad. This is definitely a very, very well-run company, but it's in a tough space at the moment. So I'd just be a little bit careful.
Yeah, it reminds me a bit of JB Hi-Fi in a different part of the consumer discretionary retailing, but it certainly knows what it's doing. So it's got to be able to manage that growth, and I guess it's one worth watching. And finally, property, pretty beaten up, higher interest rates, but this is a new trust coming onto the market, being spun out of an existing group. So tell me about effectively what's going to have an ASX code of ASK. So just explain that to us.
Yeah, so it's going to be a demerger of Abacus's self-storage or Storage King businesses. Now, this is going to be around about a $3 billion market cap. It's going to do quite well. I think this one overall has got the right pedigree to do well. We know self-storage is certainly doing very, very well, and it's really such a fragmented industry. With this Abacus Storage King that will be demerged and starting to trade on the 7th of August. Now, remember, it did come in at the lower end at 141. They were pricing it between 141 and 147. It came in at that lower end, so that's obviously quite good as well. They're going to leave a little bit on the table for investors to as that works through. But these guys are very, very good at what they do. So I'm really sort of comfortable with it. We know there's other storage components out, or storage businesses out there, but the market is very fragmented. ASK or Abacus Storage King will have about 14% market share, but they're about 47% of smaller mum and dads, small businesses that are in this storage space. So that leaves it ripe for consolidation. And obviously,
so it'll, as a separately listed company, have access to its own capital, shareholders, potentially a bit of a roll-up strategy, and that's where you see as the growth coming from, right?
Yeah, correct.
Driving some economies.
Yeah, they've raised a fair bit of cash, but they will continue to come back to the market and then sweep up some of those smaller fragmented stories as well. So look, 131 assets, including 110 trading stores. I think this one looks good. I'm interested to see how it's going to trade. It's a tough environment for new IPOs at the moment, but I think a storage business should do well going into the end of this year.
So a boring tech company in Phineas, a growing consumer retailer in Levisa, and then storage. You can't get much more boring than that, but looks like a good roll-up strategy. We'll start trading on the 7th of August under the code ASK. Thanks for joining us so much on Switzer.
It's great to be here. Thanks so much.
Joining me now is the Chief Economist from Morgans in Brisbane, Michael Knox. And he's recently put out a paper suggesting that the oil price is not going to remain low for the foreseeable future. Knoxy, thanks for joining us.
Thank you for asking, Peter.
Right, now, can I ask you a question? Why do you have this view that oil, is it in the third quarter or the fourth quarter, is going to start spiking higher?
Our modelling says it's in the fourth quarter that the price kicks, but we're using data provided by the International Energy Association, and there's been a couple of commentaries, interviews by Fatih Birol, who's the executive director or the chief, effectively, of the International Research Association. And he said in an interview on the 23rd of June that he thought there would be demand would be about 2.3 million barrels a day higher than supply in the second half of the year. Now, we've looked at the actual numbers as published in the May and June oil reports of the International Energy Association. And what we can see is that they expect demand to kick in the third quarter to 103.4 million barrels a day and rise again in the fourth quarter to 103.5 million barrels a day. Now, that's in a situation where the level of supply is basically flat at 101.1 million barrels a day. So that means it's undersupplied by 2.3 million barrels a day in the third quarter and 2.4 million barrels a day in the fourth quarter. And the reason that's happened is that even though, the reason that supply is short is that even though there has been an increase in supply from North America, but from the US and Canada since this time last year, of course, the Saudis have been reducing supply and have said that they will continue to have reduced supply, and the Russians say that they are joining them in that effort. So when we model what that means when you've got demand 2.3, 2.4 million barrels a day higher than supply, then it takes a little while. It takes about a quarter for it to happen, but stocks fall very sharply in the fourth quarter. And that fall in the fourth quarter of stocks tends to drive prices up. So from an equilibrium price in our model of $73 a barrel this quarter, and the price currently today, this is for West Texas, is $73.77. So we're pretty close to the actual price. Our model rises to $95 a barrel by the end of the fourth quarter of this year and kicks again next year to $112 a barrel, finishes $113 a barrel in June. So it's really this gap maintained through the third and fourth quarter drives stocks down, and it's those fall in stocks which drives up the price.
The demand that you're talking about being, relatively high compared to supply, is that linked to the view on what the global economy might be doing?
Well, it's really purely what China is doing and what the International Energy Agency in its May report and is quoted again by Fatih Birol in this interview he did on the 23rd of June, was that jet fuel demand in China rises by 61.2% in China this year. So it's the recovery it's not so much the industrial recovery, it's the recovery in the service industry generating an increase in travel and in turn jet fuel demand. Very interestingly, that's the biggest increase in jet fuel demand in the world, but the second biggest is in a little country in the Pacific called Australia, where jet fuel demand rises by over 50% in the same period. So we're experiencing the same thing. Open up after a shutdown, and it's jet fuel demand that rises, and that generates the bigger level of demand in world demand for oil. And given that the market, the Saudis and the Russians aren't matching that in terms of an increase, that drives up the price.
Okay, so just I want a yes or no answer here, Knoxy. So you mean to say that the yuppies in Australia who can't stop travelling are actually going to make the price of petrol at the Bowser more expensive?
Isn't that wonderful, Peter? Yes, exactly it.
Okay, we'll move on to the next one. Where you've actually displayed your economic brilliance, and I say that in all modesty for you, was tipping the dollar. You've been good on tipping the dollar. Where do you think the Oz dollar is going to be by year's end?
Well, I'm sorry, it's not. It's going to be a little bit stronger than it is now, maybe about 5 cents stronger than it is now, so modestly stronger.
And then, and rolling into 2024, does it continue? Because you've said to us in the past, eventually there will be focus on how big the US budget deficit is, and that can be a driver of the US dollar down and other currencies up. Is that still the view you take?
Yes. What's happening is, as a result of the Inflation Reduction Program, which is entirely the reverse, actually, it's subsidies manufacturing for green manufacturing, electricity, batteries, electric cars, made in union workshops, union factories. The level of the US budget deficit is about 5% of GDP this year, and it widens over the next 5 years to 7% of GDP. Now, this is the IMF figures. Don't trust me, trust the IMF. And this is what is called the general government sector, which is the combination of both the federal government and the state government. Now, for comparison, Australia is currently, even though the federal government is balanced, there are state government deficits. So the IMF makes the general government sector here 3% of GDP, declining to 2% of GDP in a year or two's time. And the Europeans are around about the same level. So US dollars are being created over the next 5 years at a much faster rate than either Australian dollars in the market or the euro, and that generates downward pressure on the US dollar.
Okay. My financial planning clients will be very happy because the last time you tipped a rising dollar, one of my clients actually bought a car out of the windfall benefits he got from his IHVV distribution. So he'll be happy to know you're on the money again. Well, let's hope so. Let's go to Aussie inflation. Big story here. What's your do you think we'll get on top of this inflation with the amount of interest rate rises we've seen so far, or are you expecting more?
Oh, we expect more interest rates. We've been settled year that we thought that the cash rate would peak at 495 basis points. Right now, the Federal Reserve is at 5.1, and the reading of the last the summary of economic projections released at the last Fed meeting suggests that the Fed funds rate is going to rise to 5.6. That's 2 more rate hikes after a pause, and then 2 more rate hikes. We think at this pause and then 3 more rate hikes, 495. Why do we say 495? Well, because in the previous resources boom earlier this century, we peaked at 475, which is, and that's the closest you can get to that. At the moment, what the RBA is doing, it's moving to levels of the effective Fed funds rate. So 475 basis points low end for the Fed funds rate, plus 10 basis points is 485. So that's why we picked 495. But the market currently is consensus is now 460 basis points. We're just a touch higher than that.
All right, so let's just presume that your historical economic brilliance could be challenged by something we've never seen before, and that is a mortgage cliff where 40% of fixed rate home loans are rolling off. Usually it's 15%, but this time it's 40%. Could that be a curveball that you can't factor in terms of how this economy could be affected in the second half?
If there was no immigration this year or next year, that would be absolutely correct. House prices would fall. That would generate consumers would feel less wealthy. They would spend less. Retail sales would fall heavily, and yeah, and inflation, of course, would decline after that. But what's going to happen, of course, is that, I've been talking to some business people in the last week, and they say unemployment's 3.5%. Well, how come there's nobody unemployed that we can give jobs to? So the problem is that, the employment market in Australia is extremely tight. Now, it's necessary to import more people to fill those job positions. But as those people enter the economy and get jobs, they're going to get full-time jobs, and those full-time jobs qualify them for mortgages, and that increases housing demand. So the increase in demand from immigration offsets the fall in demand from rising interest rates, and house prices hold up, much to everybody's surprise, and domestic demand holds up, and then therefore inflation is harder to knock over. But so what we think is that, and the president of the San Francisco Fed has phrased it this way in the US, Mary Daly, she's said that the strategy of the Fed is raise and hold, and hold rates until they actually see inflation in the US go down to towards the target area, and we believe that's what's going to happen in Australia, raise and hold. So when we get rates up to this peak of, we think, 495 basis points, then the RBA will hold until damn near the end of next year. So much higher for longer than people, or not much higher, but a little bit higher, but for much longer than is commonly expected.
Okay, Knoxy. Well, we'll end on that. I hope you're wrong. I very seldom say that, but I hope you're wrong, because the people you're talking about who are feeling the pain now, and once you do over the next 6 months, that they will be feeling the pain for probably another year or so, and that's something I hope doesn't work out. But as per usual, I look forward to seeing whether your continued economic brilliance is sustained. Thanks for joining us.
Thank you, Peter.
That's Michael Knox of Morgans. And that's the show for tonight. Thanks for joining us. Remember, if you want to know more, go to the Switzer Report. That's switzerreport.com.au. And earlier this year, I said to you, eventually this program will be behind a paywall, and you will have to be a subscriber to the Switzer Report. That's something that will be happening pretty soon. I hope you can become subscribers to the Switzer Report. We've done this for a long time for nothing, but I think it's time that we all became closer under the umbrella of the Switzer Report. Thanks for joining us. I'll see you next week.